welcome back to Dukascopy TV. I'm Natalie MacDonald and you're watching another exclusive interview. Joining me in the studio now is Cédric Dingens from Notz Stucki. Cédric, thank you so much for coming in today.
You're welcome.
Now, firstly, Cédric, can you talk me through how portfolio management has evolved over the last few years?
Yeah, sure. Since 2008, the world has changed, and investors have a common characteristic is that they try to identify the best way to hedge their portfolios. This being said, I mean, the current context of the financial markets are quite difficult, and it's not easy for them to identify the best way to hedge their portfolios today. As a consequence, in terms of portfolio construction, they have to look more in terms of building blocks and not really in terms of asset classes, like it was the traditional way to look at it.
So are there strategies and building blocks, as you mentioned, therefore, that can allow to mitigate risk?
Absolutely. So this is a really important thing, is that for each building block to assess the risk associated with it. So for instance, if you look at the different strategies you have, CTAs are an interesting play. Why? Because 90% of the time when there is a market stress, I mean, they show positive returns. So clearly it is a good diversifier. Then you can think of gold, especially in this current context of financial repression. And if the outcome of all the interventions of central banks is really bad at the end, you could be happy, I mean, to have some physical gold in your portfolio. Then what about hedge funds? We talked about CTAs. I think that the good attribute to hedge funds is clearly that the owners of capital of hedge funds are also the ones that manage money. There is an alignment of interest between investors and hedge fund managers. It is a good thing. Then, I mean, hedge funds have been quite disappointing in the recent period, but I think that on the long term, they still represent something interesting in a portfolio.
You mentioned there sort of several different areas, but how does one combine those strategies and then measure the risk of that portfolio?
Risk management is clearly a thought process. You have to think about risk management in terms of qualitative process. Risk measurement is a different aspect. It's clearly a quantitative exercise. So this being said, what you really hate, I mean, in terms of risk management is large negative surprises. And there, I mean, what you want to have is something to protect yourself. So how do you do that? I mean, you can have different statistical tools like conditional value at risk to measure risk. But we know that there are a lot of limitations to that. So an alternative way to work on that clearly is to think about your main portfolio like building blocks and then try to optimize that with, for instance, considering risk as volatility as risk. We know the limitations of that, but that's the first step. And then in the second step, you can try, I mean, to have a tail edge portfolio, which goal will be like a portfolio insurance to protect the main portfolio.
What sort of strategies do you use, therefore, in a tail bucket risk?
So you have different tools available on the market today. Mainly what you have in the credit derivative space, you have strategies like CDS index hedgers on the iTraxx, main iTraxx, crossover financials. This is a first example of hedgers you can use, and especially if you have a credit portfolio, you will think about those kind of hedgers to do the job. Unfortunately, it is true that it was not so successful in the sense that we saw the difference between CDS levels and cash bond spreads, for instance, corresponding, I mean, underlyings were quite varied a lot over time. So it was not so effective in terms of hedging. The good thing is that, I mean, there is a strong relation between equity and credit. So even if you have a credit portfolio, you can try to use the equity derivative space to hedge your portfolio. And then you have two categories. You have first the vanilla equity options and a kind of new market, but not so new, actually, the equity volatility market. And in the second category, the equity volatility, now the market is more mature, liquidity has improved a lot, and there have been new algorithms on the market that can be used, I mean, to be protected. So basically you have two legs, one being long volatility, one short volatility. so that you mitigate the cost of carry of being long volatility, and at the end you have a kind of payoff that is interesting to protect your portfolio.
Cédric, that's great. Thank you so much for your comments on that. Now that does bring us on to our Dukascopy question that we ask each of our guests at the end of our interview, and that is, if you had $1 million to invest for 1 year, what instrument would you place it into? So if we have a look at the board and look at our options today, we've got real estate, equity, bonds, gold, cash and oil. So Cédric, $1 million for 1 year, where would you place it?
I will tend to prefer equities. Why? Because it's a little bit by default, I would say, but I think there is more risk now in the fixed income market. The risk reward is not there anymore. Regarding gold, oil and different asset classes, I don't have a clear opinion on that, but I think that having a portfolio of very good companies with, cash flows that can be identified, global companies that can benefit from the growth of emerging markets at the end is still perhaps the best way to be invested today still. That's great. Cédric, thank you so much for coming into the studio. Thank you.
For more interviews like this, stay tuned to Dukascopy TV. For now though, goodbye.